Warren Buffett is sitting on the largest cash pile in Berkshire Hathaway's history, and when the most successful investor of all time refuses to buy stocks, you should probably pay attention. This isn't about one man's investment decision. This is about what the smartest money in the world sees coming that most retail investors are completely ignoring. Today, we're going to break down exactly why Buffett is hoarding cash, what the indicators he watches are actually telling us, and most importantly, what you should consider doing with your own portfolio right now. Let's get into it. To understand why Buffett is sitting on the sidelines, you first need to understand how he measures whether the stock market is cheap or expensive. Back in 2001, Buffett told Fortune magazine that there's one ratio that stands above everything else when it comes to valuing the overall market. He called it probably the best single measure of where valuations stand at any given moment. That ratio is now called the Buffett Indicator. It takes the total market capitalization of all publicly traded stocks and divides it by the country's gross domestic product. In simple terms, it compares the size of the stock market to the size of the economy. The logic is straightforward. Over the long run, the stock market should grow roughly in line with the economy. When the market gets way bigger than the economy, stocks are expensive. When it's smaller, stocks are cheap. Here's where it gets interesting. Right now, the Buffett Indicator is sitting at approximately 220%. That puts us deep into what analysts call significantly overvalued territory. To put that in perspective, before the dot-com crash in 2000, this indicator peaked at around 140%. Before the 2008 financial crisis, it hit similar levels. We're now significantly higher than both of those peaks. When you look at where this indicator stands today compared to historical readings, it suggests the stock market is more disconnected from the underlying economy than at almost any point in modern history. And Buffett isn't just talking about this indicator, he's acting on it. He's selling stocks and piling up cash. That's not speculation. That's observable behavior from someone who has been doing this for over 60 years. But the Buffett Indicator isn't the only warning sign flashing red right now. There's another measure that serious investors watch closely called the Shiller CAPE ratio. CAPE stands for Cyclically Adjusted Price to Earnings. It was developed by Nobel Prize-winning economist Robert Shiller. Here's how it works. Instead of looking at just 1 year of earnings, which can be distorted by short-term factors, the CAPE ratio takes the average of inflation-adjusted earnings over the past 10 years. This smooths out the business cycle and gives you a more stable picture of whether stocks are cheap or expensive relative to their actual earning power. The long-term average for this ratio sits somewhere in the mid-teens to low 20s. When it gets above 25, historically, that's been a warning sign. When it gets above 30, you're in expensive territory. Right now, the Shiller CAPE ratio is hovering around 39 to 40. That's near the levels we saw at the peak of the dot-com bubble. It's significantly higher than where we were before the 2008 crash. Now, does a high CAPE ratio mean the market will crash tomorrow? No, markets can stay expensive for a long time. They can even get more expensive before they correct. But here's what the historical data shows. When you buy stocks at high CAPE levels, your returns over the next 10 years tend to be significantly lower than when you buy at low CAPE levels. It's not a timing indicator, it's a valuation indicator. And valuations matter for long-term returns. Warren Buffett knows this. He's been through multiple cycles. He's seen what happens when people ignore valuation because they think this time is different. Now, you might be wondering if we're actually in a bubble or if this is just normal market behavior during a bull run. There's a research firm called DataTrek that developed what they call a 3-point bubble checklist. It's a simple framework for identifying when markets have crossed from expensive into genuinely dangerous territory. The first warning sign is an IPO frenzy. When companies with no profits, no clear path to profitability, and sometimes barely any revenue can go public and immediately double or triple in value, that's a bubble behavior. It means investors are so eager to get into the market that they'll buy almost anything. The second warning sign is bad mergers and acquisitions. During bubbles, companies make stupid deals. They overpay for acquisitions. They buy companies that make no strategic sense. They do it because their stock is so inflated that it feels like free money. When you start seeing deals that make you scratch your head and wonder what the buyer was thinking, that's a warning sign. The third warning sign is what they call the double is a bubble rule. When a sector or the overall market doubles in a short period without a corresponding doubling of underlying fundamentals, that's typically bubble behavior. You can look at recent market behavior and check these boxes for yourself. Think about the IPO market over the past few years. Think about some of the acquisitions that have been made. Think about how quickly certain stocks and sectors have doubled. There's another factor that serious investors are watching right now, and it doesn't get enough attention. Look at what's driving the market higher. A huge portion of the gains in the major indices have come from a small handful of stocks. You've probably heard them called the Magnificent Seven. When a small number of stocks are responsible for most of the market's performance, that's concentration risk. It means the index doesn't reflect what's actually happening across the broader economy. It means if those few stocks stumble, the whole market could follow. This kind of concentration has happened before. It happened before the dot-com crash, when a handful of tech stocks were carrying the market. History shows that extreme concentration often precedes significant corrections. The average stock in the market may not be as expensive as the headline numbers suggest, but if you're invested in index funds, you're heavily exposed to those expensive, concentrated positions at the top. This is something Buffett would be acutely aware of. He doesn't just look at the market as a whole. He looks at individual businesses and asks whether the price makes sense relative to the value. Let's talk about another indicator that has an almost perfect track record, and it's been flashing warning signs. The yield curve is one of the most reliable recession predictors we have. It has signaled every U.S. recession since 1955. That's roughly 70 years of accuracy. Here's how it works. Normally, when you lend money for a longer period, you expect a higher interest rate to compensate you for the added risk and the time value of money. So a 10-year Treasury bond should pay more than a 2-year Treasury bond. When that relationship flips, when short-term rates are higher than long-term rates, we call that an inverted yield curve. It typically signals that investors expect trouble ahead. They're willing to accept lower long-term rates because they think the Fed will have to cut rates aggressively in the future to fight a recession. The yield curve inverted significantly starting in 2022. It was the longest inversion since 1978. But here's the part most people miss. Recessions don't usually start when the yield curve inverts. They often start when the curve normalizes, when it flips back to normal. That's typically when the Fed is cutting rates in response to economic weakness. We're in that normalization phase now. The curve is flattening out after being inverted. Historically, this is when you need to be paying the most attention. The Cleveland Federal Reserve actually tracks this indicator and uses it to predict GDP growth. It's one of the tools serious economists use to gauge where the economy is heading. Buffett has lived through every recession since the 1,950 seconds. He knows what the yield curve signals. He knows that the real danger often comes not during the inversion, but during the aftermath. So, what are sophisticated investors actually doing right now? Central banks around the world have been buying gold at record levels. We're talking over 1,000 tons annually in recent years, roughly double the pace from just a decade ago. Countries like Poland, China, and India have been leading these purchases. Gold now represents about 20% of global reserves. When central banks stockpile gold, they're essentially hedging against the very currencies they issue. They're buying insurance against a scenario where paper currencies lose value. During the 2007 to 2009 financial crisis, gold rose over 25% while stocks fell nearly 57%. That's why it's called a safe haven asset. It tends to perform well exactly when other assets are performing poorly. This is the kind of behavior you see from institutions that think long-term and can't afford to be wrong. They're not making bold predictions about crashes. They're quietly positioning for a range of outcomes that include significant market stress. Buffett has been increasing his exposure to certain hard assets and reducing his exposure to equities. He's essentially doing the same thing central banks are doing, just through different instruments. Here's what makes bubbles so dangerous and why most investors get caught in them. Human psychology is wired to lose money in markets. This isn't an insult. It's just how our brains work. Research from behavioral economists, including Nobel Prize winner Daniel Kahneman, shows that we feel the pain of losses roughly twice as intensely as we feel the pleasure of equivalent gains. This is called loss aversion. But there's a flip side. During bull markets, we experience what's sometimes called greed. We see stocks going up. We see our neighbors making money. We see people on social media posting their gains. And our brains tell us we need to get in before we miss out. This is why most investors buy high and sell low. They buy after stocks have already risen because that's when it feels safe. They sell after stocks have fallen because that's when the pain becomes unbearable. The CNN Fear and Greed Index tracks 7 different indicators to measure market sentiment. It looks at things like the VIX Volatility Index, market momentum, and put-call ratios. When the index shows extreme greed, markets are often near tops. When it shows extreme fear, markets are often near bottoms. Buffett's famous advice is to be fearful when others are greedy, and greedy when others are fearful. He's not just saying that to sound clever. He's describing a systematic approach to investing that goes against every natural instinct we have. Right now, by many measures, we're seeing elevated levels of optimism. Retail investors are piling in. The "this time is different" narrative is strong. People have rational-sounding explanations for why high valuations are justified. Buffett has seen this movie before, multiple times. He knows how it ends. Let's look at what happened in previous market cycles when valuations were this stretched. In 1929, markets crashed, and it took roughly 25 years for investors to recover their losses in real terms. That's not a typo. 25 years. After the dot-com bubble burst in 2000, the Nasdaq took over 12 years to get back to its previous highs. If you were fully invested in tech stocks at the peak, you sat through more than a decade of regret. The 2008 financial crisis saw stocks drop nearly 57% from peak to trough. It took about 4 years for the market to recover. The 2020 pandemic crash was different. Markets recovered within months, but that was largely driven by unprecedented stimulus and near-zero interest rates. Those conditions don't exist today. Here's the key insight. The market always recovers eventually, but the time it takes to recover varies enormously depending on valuations at the peak and the nature of the decline. If you're buying at historically high valuations, you're extending your potential recovery timeline. This is why Buffett focuses on the long term but is extremely patient about entry points. He'd rather sit on cash earning modest returns than deploy capital at prices he considers unreasonable. There's another factor in play that affects anyone holding U.S. assets. The U.S. dollar's share of global foreign exchange reserves has been declining for decades. It was above 70% in 2000. It's now closer to 57 to 58%. Countries are slowly diversifying away from dollar holdings. The U.S. national debt stands at approximately $37.3 trillion. That's a number so large, it's almost meaningless to most people. But here's what matters. Servicing that debt takes an increasingly large share of the federal budget. Now, there are counterarguments. The dollar still dominates about 88% of foreign exchange trading. There's no viable alternative right now. The Chinese yuan represents only 4 to 7% of global trade. The euro has its own problems. This isn't about a sudden dollar collapse. That's probably not in the cards. It's about gradual diversification and the slow erosion of purchasing power that comes from persistent inflation and debt accumulation. Buffett has been vocal about the risks of currency debasement. When governments spend more than they take in and make up the difference by printing money, the value of that money tends to decline over time. This is another reason hard assets and productive businesses become valuable. They represent real stuff, not just paper promises. So, with all this in mind, what's the practical takeaway? First, understand that none of this is a prediction that the market will crash tomorrow. Buffett isn't predicting a crash. He's positioning for a range of outcomes. There's a difference. Markets can stay expensive for years. They can even get more expensive before they correct. Timing the market is essentially impossible to do consistently. Even Buffett doesn't try to time the market. He focuses on valuation. Second, having cash isn't a failure. Buffett holding a massive cash position isn't him admitting defeat. It's him waiting for opportunity. Cash is a call option on every asset in the world. When prices become attractive, cash lets you act decisively. Third, think about your own portfolio allocation. Are you comfortable with your current level of stock exposure if markets were to drop 30, 40, or 50%? Could you stay the course without panic selling? If the answer is no, that tells you something about your risk tolerance. Fourth, consider your time horizon. If you're dollar cost averaging into index funds over the next 20 or 30 years, short-term valuations matter less. You'll buy through multiple cycles. If you're planning to retire in 5 years, current valuations matter a lot more. Fifth, understand the psychology. The biggest danger isn't the market going down. It's you making emotional decisions when it goes down. Data shows that investors who panic sold after major downturns and waited to reinvest often turned millions of dollars into a fraction of that amount compared to those who simply stayed invested. A buy and hold investor who contributed consistently from 1,980 onward would have built roughly $6.1 million. An investor who panic sold after downturns and eventually reinvested would have around $3.6 million. And an investor who sold and stayed in cash would have ended up with just $524,000. The math is brutal and clear. Your behavior during scary times is the single biggest determinant of your investing success. Warren Buffett sitting on $300 billion in cash isn't a signal to panic. It's a signal to pay attention. The Buffett Indicator at 220%, the Shiller CAPE ratio near dot-com peak levels, the yield curve normalizing after its longest inversion since 1978, extreme market concentration in a handful of stocks, central banks stockpiling gold at record rates. None of these things guarantee a crash, but all of them together suggest we're in an environment where caution is warranted. Buffett has been doing this for over 6 decades. He's been through the 1,973 to 74 bear market. He lived through the 1,987 crash. He navigated the dot-com bubble and the 2008 financial crisis. And through all of it, his approach has been consistent. Focus on value, be patient, and never forget that the market can stay irrational longer than you can stay solvent. The point isn't to predict exactly what happens next. The point is to position yourself so that you can survive whatever happens and capitalize when opportunities emerge. Buffett once said that only when the tide goes out do you discover who's been swimming naked. He's making sure he's got his clothes on. The question is, do you? That's it for today. If this helped you think differently about the market, consider subscribing. We break down complex financial topics in a way that actually makes sense. Until next time,